about credit scoring, and the purpose of the class is twofold. Number one, it's for your own personal information. It's to help dispel the myths that exist around credit scoring. It's not a secret, though people act like it is, okay? So if you can learn a few things, you're going to be able to manage your own personal credit score. What will that do for you? Tons of things in regards to managing your personal finances. I don't know if you realize this, but virtually everything you do, they pull a credit report. And many of the things that you pay for are directly associated to your credit score. One of the best examples is insurance. So you want to apply for some new auto insurance or home insurance, they're going to pull your credit report. And how they rate you will be partially associated to your credit score. Okay? So that's the first part, is to give you the information and dispel myths. The second part is to show you how being aware of and having this knowledge about credit score is going to help you do maybe not so much more business, but definitely better business, which should translate into more business. You can quit spinning your wheels where you shouldn't be spinning them, spending time where you shouldn't be spending it. Okay? Are we not? Okay, mouse isn't going to work today. So there's one thing I'll change here, but defining credit scores go from, depending on who you talk to, 350 to 850, okay? And so what you're looking at is the higher the score, unlike golf, the better chances of credit, the lower risk is presented by the higher score, okay? So everything pretty much in the lending world works on 20-point increments. You started out at 850 as being the highest score you have. I've never ever seen that. Chris, have you?
No, highest
Okay.
I've seen is 825.
See, now that's the highest. 812 is the highest I'd ever seen. So when they break 800, they're the pinnacle of lowest risk when it comes to credit. That's what credit score represents, is the risk to the lender. Okay? So the next break, and this has actually changed, I need to update that, is actually 760. So it's been recently added, probably about a year or so ago, where mortgage insurance companies are giving discounts for people with a 760 credit score or better. So if you've got a conventional loan that needs mortgage insurance, so they have less than 20% down and they have a 760 credit score or greater, they will get a discount for that. It has not effectively translated in the mortgage industry. It may not, but it does therefore help reduce or improve their debt ratio, which gives them a lower risk or a better risk to the lender as well. The next drop is 740, and then on down 720. If you're below 720 and you're looking to borrow money, you're actually starting to get in trouble. Rates are starting to be quite a bit higher. You hit the 680. 680, when credit scores first came out in the mid-90s, 680 was actually considered a very good credit score. If you got a 680 or better, we thought you were great. But over time, they're constantly changing, updating the logarithms, the programming that goes into how credit scores are calculated, so they're tweaking those. On top of that, your major lenders, Fannie Mae and Freddie Mac, are constantly adjusting their automated underwriting systems based on the performance of the current loans that are in their portfolio. So they're going to make changes. And what they found is 680 or less, you're starting to get into what they consider a danger zone for risk tolerances, okay, whether the loan's going to go bad. Does anybody know what the mortgage credit score actually represents to the lender? Okay.
How will they repay the bills?
To some extent, the actual risk analysis that produces this credit score is what are the chances of any particular borrower ever going over 90 days delinquent. So it's not, are they good today? It's what are the chances in the future of how well they're going to perform. So knowing that, if you think about it, what happens at 90 days? Notice of default. The foreclosure process starts. So this is an indication to us of what are the risks, what are the chances that we might actually have to start foreclosure proceedings. So now you can understand why 680 is now a danger zone, okay? If they're below 680, again, it's in 20-point increments. So 720 is good, right? 719 is not. So 680 to 719 is really the same. You're still sort of in the danger zone, okay? And you will get, and actually that's an extreme. There should be a 700 here. So it's actually 700 to 719. Okay, so 680 to 699. There is no grace for that 1 point difference. Okay?
So if somebody tries to pick up 6 or 8 points, but it doesn't cross a 20-point threshold, no difference.
It's probably not going to do them. It's definitely not going to do them any good on the rates. And I've got a slide here where I'll show you how the industry prices a loan, if you will, when it comes to loan to value and their rates. So we will see that. Okay. So no, it doesn't hurt but it doesn't immediately help in the specific lending, okay? So keep that in mind. And it used to be, when credit scores first came out, when we were first dealing with automated underwriting, which would have been in I think the first loan I worked on was 96, when they really were Fannie Mae was rolling out their desktop underwriting, and they were really looking at credit scores. Up to that point, you could get exceptions all the time. You know, if the program said they had to have a 720 and they had a 718, well, you know, it's just 2 points, right? Doesn't exist anymore, not gonna happen, okay? They're gonna have to do something to change that. So the 3 credit bureaus, Experian, TransUnion, and Equifax. So we have 3 credit bureaus. The credit scores vary on each one, sometimes pretty substantially. So, and people ask, well, why is that? Well, it's how it's reported. The FICO score itself is calculated the same way, but the information in each bureau will vary. Also, the frequency at which that something might be reported as the bureaus. Some creditors only report to, say, I'm going to use an example, Experian once a quarter, but they report to TransUnion every month. It's not typical, but I have seen that, okay? Typically, the primary difference is the information the bureaus have available to them, whether it be from the creditors or public information. So, Experian may not have that you had a lien filed against you, a tax lien, but it might be on TransUnion because they happen to pick that up, okay? Same with Equifax. So these will vary. So what lenders do is we throw out the low, the high, and we use the middle. We figure that's going to be our best representation. Okay. By the way, we throw out the low, the high if it's couple, if it's joint application of both of them, and look at the lowest middle is the determining factor. Good credit never outweighs bad credit. So if you've got a husband and wife, the husband's got a 760 middle score, the wife has a 660 middle score, we use the 660. Okay.
Even though she's not
If she's on the loan.
if she-
Doesn't matter whether she earns income or not. So this is where working and getting a hold of Chris ahead of time, getting your borrowers to talk to Chris ahead of time is imperative, okay? And because, number one, he needs to pull both their credit reports almost all the time
Right.
on a joint. I know Chris is going to want to pull both the reports so he can help assess the situation. If one of them doesn't work, you take them out and try to make it work with one. But he's a very good strategist on this stuff and helping get loans together. It's very difficult if they've fallen in love with a house already, guys, and then you send them to Chris. Because now he's trying to fit a square peg into a round hole. Much better if you get it there ahead of time and Chris is able to work with them. And let's say they are a few points off. He can give them some guidance to, okay, pay this, pay that, or do this, and we're going to see your score come up the few points you need to put you in a better position. But again, if you wait till you wrote a contract, you got 45 days, he doesn't have time. There's not enough time. You need, on average, 60 to 90 days to make a substantial difference. Not all the time, and you're going to learn how and why here in a minute. Okay? So the credit scoring model, there's the primary reason that it was adopted was to give a way to evaluate people's risk. You know, prior to the credit score in the mortgage lending industry, or the development of the FICO score, you could assess, do they make enough income? That's pretty easy, right? You make $1,000 a month, you want a $900 a month house payment, that's a problem, okay? That's not going to work, you're not going to be able to repay the debt. You want a $300 a month payment, okay, that makes sense. Those are percentages and ratios that we could use to determine affordability, okay? You could also do that with every other aspect. What's the loan to value? How much are they putting down? These are numbers and ratios that the industry already had standards for. That it was not the case until the credit score was developed. Now on the consumer lending side, and I did consumer lending a number of years ago back in the 80s, we did actually have a credit scoring model. Have you ever heard of that? Consumer credit scoring. You know, banks, they develop their own. They'd say, okay, you've lived in your house for 2 years, there's 1 point. You have a credit card with a good pay history, there's another point. And if you got 5 points on your car loan application, you got the loan. And so, I mean, on consumer lending, they had a way that they would give points and all this and develop their scoring model. But on the mortgage side, we had no way to evaluate the entire profile of your credit and say, is this person a good risk or not? So that's the major reason that was the reason it was adopted. Refi boom we're not really dealing with right now. Refi boom caused some additional problems in the credit and underwriting issues and delays and credit inquiries causing issues. Not really a problem now. I should update that slide. Okay, here is the meat of your credit score. This is for you and for when you're talking to clients. This is what we utilize, this is what Chris utilizes to guide them as to what they need to do if they need to improve their credit score. If you understand the first two more than anything, you're going to be able to manage and manipulate, I should say, I'm on video, so I will say manage your credit score in the future, okay? So 35% of your score comes from credit history. There is an A and a B to credit history, and we're going to get rid of some myths right here. The first part is obvious. Do you pay your bills on time, right? Have you been late? If you have, how often? How long ago has it been due? Were you just recently late? And if you were late on anything in the last 12 months, it has a much greater bearing than if it's been more than 12 months or more than 24 months. The further back in time it is, the less impact it has on your credit score. By the way, it never goes away. I'm sure Chris has had this question. Well, that was 8 years ago. That's still on my credit report? Yes, it is. As a matter of fact, we know probably where you went to high school and who you dated. And no, I'm just kidding on that stuff. But anything that was ever reported is probably on your report. Couple of exceptions is derogatory credit. Some of the credit bureaus have had in the past, and this could change at any time, so that's why I say have had. TransUnion would automatically delete for any negative credit history that was over 5 years old. Okay? Not if it had been currently updated, that's a whole other issue we'll talk about in a minute. But anything that was just stagnant over 5 years old, they used to have an internal policy that they just eliminated it. Because they knew they were going to get pushed, that people was going to start writing letters, consumers and credit repair companies, to take them off anyway. So they would just automatically do that. Part B, though, of credit history is the length of credit history. So, one of the myths, close your accounts, you have too many accounts. Absolutely one of the most erroneous things you can do for your credit score, okay? Because in this 35% calculation, they're looking how long have you had credit. So if you got a JCPenney's card when you first went away to college, and now you're 50, so you've had it for 30 plus years, and you close that account, 30 years of credit history is gone. It doesn't see it anymore in your credit model. So if you close it, your score will actually go down because you had a 30-year perfect pay history with pennies, and now it's not there, okay? So closing accounts is the worst thing you can do, particularly accounts that have had any history. Now, if you've had the account for 6 months, might actually help your credit score to close it. It's different with each person, but you want to send them to Chris, have him talk to Chris, so he can help evaluate that. Chris doesn't have to guess, by the way. He can look at it and go, well, I know you do these things, but I know the service that he used will actually let him run a credit analysis, which will tell him what they can do to improve their credit score.
Is it ever possible to get the breakdown like this on your credit score? Like how you're doing for credit history, debt ratio, all of that?
Yes, it actually is.
Okay.
And I'll show you how to do that shortly.
Okay.
Okay? So the next part is debt ratio. This isn't talking about income versus expenses. This is your credit debt ratio, I refer to it as. In other words, what percentage of your debt, your open credit lines, are being utilized by you, okay? And it just so happens, this is an easy one, 30% is the magic number. 30% or less, if you're using 30% of your, or less of your limits, then you're going to have the best possible credit score, okay? So if you've got a credit card with a $1,000 limit, if you owe $300 or less, that's going to give you a better credit score than if you owe $900. So you're losing 30% of your limit versus 90% of your limit. So this is probably the easiest way in the world to help manage your credit score, okay? And that, like I said, it's the same. It looks at the individual accounts when it's calculating the score, but it also looks at all of them. So if you have 10 $1,000 credit cards, you have $10,000 available, okay? If you've got them all at $900, so then you've utilized 90% of your credit across the board. If you have one card at $900 and the rest of them had $10 on them, you're probably not hurting your credit score that bad, but it looks at everything cumulative, and it looks at each individual account as well, okay? Those two things alone will help you manage your credit score, and I'll specifically show you how to do that in a minute. Okay, credit length. I already kind of made that part B of credit history, but how long you've had an open account. Did you just open it? You've only made 2 payments to it? Have you had it open for 24 months and made 23 payments on time? So that's what that's about. How long have you had the account? Does it have a pay history? Do we know what your habits are with that account? Credit type. This one hurts a lot of people if they're already on the bubble. Where did you get your credit from? Is it from a major bank, a major financial institution? Or did you go down to pick any furniture store that you want to, and did you get one of their credit cards so you could buy new furniture for your new house that's underwritten by a finance company? So any kind of underwriting by a finance company is going to be a negative on your credit history, or your credit scoring, is because of the kind of credit. Because then the assumption is, why couldn't you get a MasterCard or Visa? What are we missing here?
So
Go ahead.
we just financed new flooring at Lumber Liquidators
Mhm.
because it was no interest for 2 years.
Mhm.
Did that hurt us?
Could have. The truth is yes. But notice it is only 10% of your score, so if you already have an 800 credit score and everything else is perfectly balanced, take advantage of the 0%.
Yeah.
I'm not saying absolutely don't, but if you are looking to manage your credit score, you probably don't want to.
Okay.
Okay? I've done the same thing. Synchrony Financial did financed my floor, and I got 12 months, 0 interest in my house. It was very nice to be able to do that, but I did actually watch my credit score go down.
Okay.
It's okay. I'm not looking to buy anything, so it was fine. Okay?
Interesting.
So that's part of what I say, managing your credit score. That's you being aware of what you want to accomplish, and does it matter? Does it matter if your score drops 20 points to you once you've gotten the credit in place? If it doesn't, because you're not going to buy a house or a car or apply for insurance, then don't worry about it. Do what's best for you. In this case, 0% interest for 24 months,
Yeah.
did you say?
Yeah.
Should have checked in with you first. I only got 12. Okay. So inquiries. This is a big one. People are seriously concerned about the number of inquiries in the credit report. They'll tell a loan officer, hey, we don't want you to pull our credit because I've already had somebody else do that. So understand that inquiries does have an effect. Does it have as big effect as people want? Or concern? No, absolutely not. Again, it's 10% of the model. What matters the most is not just how many, but what kind. Okay, if you're out shopping for credit, so you went and applied, you did a home loan, or you've got pre-qualified by Chris today, and you got all excited. You think, okay, we're moving into a nice new neighborhood, just graduated. I'm going to go get a car, and let's go to Star Furniture and let's apply for some furniture so we can pick out the furniture we want to put in our new house. Oh, and by the way, let's apply for a new American Express because I just graduated. I should have a gold card, right? If you're going through a litany of different types of credit applications, that's a red flag. That's going to have an impact on your score. If you're applying for just one kind of thing, probably not. As a matter of fact, MyFICO, who developed the score, so FICO Credit Scoring, has a website called myfico.com. You can look at all of this information is available there if you want to go read it for yourself, okay? So on the FICO scoring model for the inquiries, if it's the same kind of credit within a 7-day period, consumer credit, so you go to apply for a loan, for a car, and every finance guy, they run it by half a dozen people, see who's going to give the best deal. By the way, it's not for you, it's to see who they can get the biggest interest rate spread from for themselves. But they run it by half a dozen banks, all those banks pull your credit report, it only counts as one inquiry, okay? So you could go around from dealership to dealership. If you do it all within the same week, one inquiry. So it has almost no effect on your credit score. And you'll look at it, there might be 15 inquiries, but it's one in the world of credit, okay? For mortgage lending, it's 14 days to 30 days. I have not been able to confirm this. So we're not absolutely positive whether it's 14 days to shop and have other lenders pull it, or it's 30 days. My experience has been it looks like it's 30 days, but there is no absolute written. FICO.com has not come out and said, Fair Alex says, you got 30 days to shop for a mortgage and we don't hit your score. But that is, that's been in discussion that may have recently changed. I haven't checked it recently, but I believe it is 30 days. So they don't have anything to worry about. If you send a borrower or they come into you and you're talking to them and you want them to talk to Chris and they say, well, we've already applied and he told me I really shouldn't let anybody else pull my credit, that's a red flag to you. That loan officer either doesn't really know what he's doing or he's completely misrepresenting and fear-mongering with your client. He's spreading a myth that is incorrect, okay? He is more than welcome to shop. Matter of fact, the new TRID rules are really about encouraging the consumer to do a little shopping. You can tell your borrower that. So they really should talk to Chris to see what he can do for him, okay? It isn't going to hurt for him to pull a credit report. Now, again, if they're on the bubble with lots of other issues, it could. If they're at 32 days, Chris pulls a credit report, it could drop their score substantially, but they were already in trouble, and the reason they went to Chris or went to another lender is because they've already been challenged that way. Oh no, please don't do that. Thank you. Okay. So, this is a real Discover card. Hopefully I covered everybody's information on this. I did, good. And this is where you're going to learn a little bit more about how to actually manage your credit score, because there are some things on revolving accounts that you really need to understand and that will help your borrowers. And it's stuff that Chris knows, so he can help them improve their credit score really rapidly. But at this point, I'm going to turn the floor over to Chris. We're going to take a short break, but let Chris have something to say here about what he does and what he can do for you.
Thank you, Daniel. You're welcome, sir. Doing a great job, by the way. So I don't have a whole lot to say. Obviously, Daniel's a credit expert. You know, we all have been trained up in this so we can help our clients out. You know, we go to great lengths to help our clients to get to where they need to be to improve their credit score so that they qualify for a lower rate and they can save some money. So whenever I pull a credit report, and let's say I pull a credit report and they're sitting at a 698, so I immediately go in, you know, start running the tools and stuff like that. You know, I can immediately identify some things that they can do, but I want to put it together in writing form. So I run the tools, you know, put it together, you know, send them some PDFs, show them the credit report, go over it with them, and say, look, if we do these simple things, you know, it's going to get you to a 740 or it's going to get you to a 760. And this is what your pricing looks like now. This is what it's going to look like with the 760. And it could be as simple as paying down the balance a few $100, or you know, shifting from one card to another, or you know, clearing up a dispute, or there's any number of things that can be done. But anyways, that's about all I have to say about that. You know, our company's really trained up on the TRID. You know, we're ready to go. Probably more prepared than 95 to 99% of our competition out there. You know, so it's really not going to impact our closing time frames that much. And then we've got some new products coming where we're able to do the 203K to help folks out with renovating a home. And we've also got a new program that's going to allow us to finance a pool. So look for that, more info to follow on that. So with that, take a break.
I've got about 10:30.